Okay, so thank you for joining me. This is Millennial Money Mindset. We're going to go through the five-step method to money mindset, getting more money in your pocket, more time in your day, and more happiness in your life. Let me get the sharing screen. Oh, I'll have to edit that bit out. Okay. Okay, so the financial plan used to be easy. So previous generations, the the, you'd go to work, you'd work at a 9 to 5 job. At the end of that working life, you would have handshake, carriage clock, and a guaranteed income for life. So you would have a guaranteed pension, and essentially you'd exchange all the time you work for a guaranteed income. That would be your retirement. That would be the investment plan. Maybe you'd buy a buy-to-let mortgage. You'd have a buy-to-let property. That was basically it. That was the only option you would have. Your kind of pension. Today, there's so many options, so many complications, and with these options come kind of complications as well. So people are time poor. We don't have enough time in our day to work out how we invest, how to essentially use too much information. Thousands of different products. House prices are unaffordable, especially in London. I live in Oxford, so house prices are really expensive for a lot of people. Inflation is one of these risks that have increased massively since the 2008 financial crash, where a lot of money has been printed. Even COVID, lots of money had been printed, and essentially the spending power in your back pocket is less than it used to be. So this is just to illustrate. There's so much more complication that used to be. There's auto enrollments, and now if you work at a job, you're now auto enrolled into a pension. So there's lots more things to understand. So why invest? Essentially, for me personally, it's to become financially independent. So I have more time to spend with my family, spending my time. We talked about in the session about following your passions as well. So have more time to do that. But personal finance is personal, so you can essentially work for joy rather than working for necessity. But it depends on what you want out of life. We're all different. We're all individuals, and for one thing, one person would want one thing, another person would want another thing. Essentially, coming back to life, liberty, and the pursuit of happiness. So, Money Tips is an education company. I was a qualified financial advisor previously, and I saw how much they were charging for financial platforms. So here is a slide showing two situations. One where you have an initial fee of 5% and then 1.9% invested over 30 years. If you're investing in £500, getting average return of 6%. The difference between essentially the same investing fund, but including the fees, are hundreds of thousands of pounds. So you look at the fund, the amount of money that would be lost is over £200,000 compared to a standard fee. So this is just crazy how much. If you don't know this. A lot of people just go with a financial advisor, and they're paying hundreds of £1,000s, making the financial advisor rich rather than them. So really, one of my kind of key things that I'm looking at is essentially fight fees, making sure that people are investing for them rather than for their financial advisor. As I mentioned, I give money coaching one-to-one. We have 3 meetings over 6 weeks. I've got an online course, got 3 online courses taken by over 1,000 people. Automate your finances, a 5-step method to investing, and how to start your own business. Got 10 books as well. Here are the books up here. So we've got a number of different books. I'll show you how to access those in a moment. I've got a website called moneytips.org. Tips is spelled with 2 P's. There's a members area, loads of resources, free gift each month, and I have an investing box I've started. So here's my website. So moneytips.org is, have a look on there. There's a vast amount of wealth information on there. Podcast, Millennial Money Mindset. I've got a blog. I've got a library with some of the best books that have been published. I've got the access to publish those. Have a look, have a play around. So my book's called Millennial Money Mindset. If you want the fruits, you need the roots. I would definitely say £15. Invest in that. If this going to get you kind of pretty It's a 5-step method. It was shortlisted for a Financial Times Writing Prize, and it was an Amazon bestseller. Yeah, I do books, training, group meetups every month, and we do one-to-one coaching. So we give personal guidance, use technology, long-term focus. I won't go too much into that. So let's start off. What is money mindset? So essentially, money mindset is your thoughts, your feelings around money, how you think, how you kind of, when people talk about money, what are your thoughts and your decisions you make about money. So it's a lot to do with your emotions as well as your logic and your knowledge. So it comes down to you as well. So what were your parents like with money? That can teach you a lot about how you're taught about money. We're not taught this about in school. The workplace doesn't give you much information about investing. And to pay for this, you can go on YouTube, and there's so much information out there, and it's quite overwhelming. So I've tried to boil it down to these 5-step methods. Essentially, you want to have less stress, live your life more, have more time in your day, have more time to have experiences. Don't waste your time having talking about looking at kind of stressing up about the ups and downs of the market. So what I teach is investing, whereas a lot of other people talk about kind of speculating. So investing is owning real life businesses that are generating profits. So you're buying and selling living, breathing, or essentially buying living, breathing companies that are going to go up in value, that provide a dividend, so share the profits. And essentially, this is for long term. Whereas speculating is trying to buy and sell kind of the ups and downs of the market. So I don't really teach speculating, even though I traded for Shell Trading for a number of years. Looking at the probability is much more likely to become wealthy by looking at looking at investing rather than speculating. You're going to get kind of clobbered if you're trying to time the market rather than just long-term wealth generation. So diversify for stability and freedom and control. So we went through the 5-step method. So own yourself first, dream big dreams, have an emergency fund, diversify, and then rebalance. That's my 5-step method. So first of all, think about ownership. So it's about owning yourself, so taking responsibility, being proactive, and then setting up an automated payment system to yourself each month, or as soon as you get paid. It's much harder to do this. I totally understand if your own business. We talked some if it's your own business. Actually, when do you do this? If you're a salaried employee, it's much easier to do this. If you're in if you have a salary coming in each month, you can set up a standing order, pay yourself into a standing order, into a savings an account. Once you've reached a certain amount, then you can start investing, pay down your debt first of all. So that's ownership. So own yourself first, but also there's kind of a deeper meaning about ownership. Essentially, look at, so we're in a capitalist world, and the way wealth is built is the owner is going to get wealthy and the worker is going to get, essentially, you're going to keep working for exchange your time for money. So if you want to build wealth, you have to have an owner mentality. You have to own yourself. Buying shares, you become a part of that business. You're owning that business. That business is going to pay your profits. If you buy a buy-to-let, I've got a buy-to-let property in Bristol. Every month, rent comes in. The tenant pays me because I own that property. As a renter, you're paying rent each month. If you own that business, it's much easier to build wealth if you own that property. If you look at bonds where you're lending money, it's much easier to build wealth if you're the lender rather if you're borrowing money. If you're using credit cards every month and paying compound interest, you're going to end up paying someone else for using that money. Rather, if you're the owner, if you have bonds where you're lending money, this could be premium bonds where you're lending to the government. This could be corporate bonds where you're lending to corporations. Then they pay you every month to what's called a coupon. So you're going to build wealth that way. So having this ownership mentality is really important. So part of everything you earn should be yours to keep. So think of yourself as a business owner, business system. So, and at the end of the year, you should have profits. Why are you working? a lot of people meet kind of end up being working paycheck to paycheck. So we have this kind of paycheck circle of life where you go to work. A lot of people kind of fall into this mentality where you have you get paid, you spend everything that you earn, and at the end of that month, you're left with nothing. So at the start of when you get paid on the end of the month, the 26th, when that money reaches your pay packet, you feel really rich. You go out and spend money. You go out, buy nice things. You spend it on going out, and then you spend all that money. And by the end of that month, you're back to square one. So a lot of people fall into this kind of payday circle of life. From what you said earlier, it sounds like you guys have a lot more kind of advanced than this, but a lot of people, especially when they're starting out, fall into this trap. So it's kind of breaking this trap. So we talked a bit about writing down your assets and liabilities, understand what an asset is, kind of coming back to the core fundamentals. An asset is something that puts money into your pocket. This could be a buy-to-let property. This could be money in the stock market. This could be where you're lending money. It also could have your own business. We talked a bit about startup capital. You could own 5% of that kind of ownership, and that's going to put money into your pocket later on. If you have mortgages, I live in this house at the moment. I have a mortgage. That's a liability, but at one point I'm going to pay this off, and then this property will be mine. So it's reducing your liabilities. Don't take out kind of credit cards, spending, especially if you're kind of consumer credit. That's really dangerous. And having a kind of, what would your dream life look like? So I created this little image here. My dream would be, I mean, everyone would love to have the big house. I would love to move more into the countryside. My partner and I, we talk that she wants to, potentially we're going to start a glamp site, have more time with your family, have more of a community feel. Yeah, that's kind of my dream life. That's what I would love to do, have enough of assets working for me that I can kind of free up my time to choose how I spend. So have the same idea, think about where you want to end up with, begin with the end in mind, start with where you want to finish up. This is going to improve and get your money mindset. So let's talk about the emotional side of money. So money is very psychological. We're kind of tied up with money, not just what actually money is, the physical coins and the physical paper, but what it does to us, how it makes us feel. So it kind of creates a lot of emotions for a lot of people. It can be tied to a lot of people. It can be kind of how we grew up in childhood. Did we have enough? What does this reward us? Especially with the stock market, fear and greed are kind of driven. I don't read newspapers anymore, the tabloid newspaper, because it's there to kind of fuel this kind of frenzy of this fear and greed, and it makes us buy more. It makes us, especially in the stock market, crash. The papers, the front page of the papers are there, kind of encouraging you to buy or sell. Adverts are on a lot of social media. We watch TV and the adverts are there. It's kind of encouraging you to make these emotional decisions that we're not enough, we're not good enough. That if you look at kind of a Coca-Cola advert, there's lots of people with these friends around us, kind of these images that we that have. This is kind of real core psychological. These people are paid lots of money to make us buy lots of things. So to try and have kind of an impact of understanding this connection with this emotion, to try and disconnect our emotional side of money, where we live in a capitalist society where it's driven by profits. If you go into a supermarket, the smell of the bakery as you walk into a supermarket hits you to make you buy more things. The product placement is perfectly at eye line to make you buy more things. So once you understand this, you can kind of see the tricks behind to try and make you buy more things. So to be aware of this, and this covers more in the books, kind of the emotional side of things. If you have a long-term goal, you can almost get away from this kind of emotional connection. If you know that you've got this this dream life that you're heading towards, it means you're not getting distracted by these short-term fluctuations. And if you can automate your payments, this coming back to owning yourself first, or have everything on autopilot. So many people I meet still trying to save after at the end of the month, when they've spent everything and they have nothing left at the end of the month. This was kind of a huge epiphany when I started out in my personal finances, just to automate your payments into, your savings. You don't even think about it, and then you get used to it. You get used to these payments, and then it kind of, it almost comes, it comes automatic, and then you'll be surprised 1 year, 2 years, 3 years, 4 years down the line how much you have managed to save. This is another kind of really key graph from Robert Kiyosaki, and it's keeping your expenses low. If you can keep your expenses low, I know inflation's risen loads, but recently, but yeah, if you can have thinking your kind of hobbies, keeping your hobbies kind of not where you're spending a lot of money, then that can be key. And then keep this as you increase, you get better at your career, your earnings are going to go up as you reinvest your money into the stock back into the stock market. You reinvest those dividends. This means that you're going to kind of, your earnings are going to go up over time. And what a lot of people do, they have this thing called lifestyle creep, where as you get paid more, your expenses go up, and then you end up with nothing left. So really key to actually try and kind of keep your expenses low, and your earnings will rise with this. So one thing to talk about money mindset, but to be really clear, you need to take action. You can't just live in your head. I'm very guilty of kind of overthinking and living in my head, where actually you need to take action. So this is why any session that I host, that I make sure that you take action. Take action is really key. Action is what makes us human. So the food won't arrive on your plate by itself. You need to go out into the world and make things happen. So this is what happens when you invest as well. So you need to set up that automated payment. You have to start investing into that stock market. You have to put that pound, starting that journey. So mindset drives success. It comes down to your attitudes towards your money. So good intentions is really key, and consistency beats complexity. So we can talk about complexity, we can get into the kind of complex stuff if you've got questions, but actually the key is kind of consistency. Doing this every month is super important. So the real secret is paying yourself every month and reinvesting those every month, reinvesting that money. So everyone can learn investing. It's not that difficult. It's really simple. So you don't need to be a math genius to learn about investing. It's really just focusing on process rather than products. So this simple method is kind of tried and tested. So get accountability from a money coach. So regular contributions and compound interest. So this is a really great graph. So it's not just about putting money into the stock market and sitting and waiting, like there's an analogy of planting a seed and let it grow. The real secret is planting that seed and then continuing to have these contributions, a regular contribution every month, and then letting this compound interest, which is compound interest is the interest on your interests. So hopefully I won't go too much into this, but there's a really good example here. If you invest £10,000 at £8,000 for 30 years, it'll grow over £100,000. So just to be clear, make sure you pay off your high interest debt first of all. So don't carry a load of debt. Pay off those credit cards first of all, and consistency matters. So there's a real good tools out there for working out compound interest. So it sounds like you guys are pretty switched on with your investing, so I won't go too much into this, but have a play around with compound interest calculators, how much you can, your projections, how much you can invest, and how much you're going to get back in the future. So projection for think decades, not days. So this projection is for 35 years with an interest rate of 7%. 7% is the kind of the average stock market return over the last 100 years or so. So it is definitely doable. So that was number one. That was essentially ownership. Number two is dream big dreams. So having a life plan, having a plan of where you want to get to. So think about where you want to see yourself in 10, 5, 10, 20 years time. So think decades, not days, and being all that you could be capable of being. So a lot of kind of psychology, if you look at Abraham Maslow and a lot of kind of core key psychologists is kind of becoming kind of reaching your potential. Actually, it's not just about being that survival mode. Once you get past that survival mode of kind of just eating and having a roof over your head, for instance, having kind of that belonging and kind of that getting good at something, then you kind of reach your kind of self-actualization, which is what Abraham Maslow talks about, kind of being your best self, being the best version of yourself. And a life plan is a really good way of getting here. So with all my clients, we sit down and essentially work out a plan of where they want to get to. We look at property, where they want to live, career, kind of what the career looks like, their family, kind of do you want a family? You need to plan that in. So I've got 2 kids, and if you look at how much they cost, they're quite expensive. So you need to plan this into your financial plan. And your lifestyle. Do you want a big lifestyle where you've got, expensive cars, expensive big houses, kind of travel around the world? Or do you want a small lifestyle? Do you want, a less extravagant lifestyle? Then you're going to need less assets. So if you have a big lifestyle, you're going to need big assets. If you have a small lifestyle, you just need small assets. So depending on you, personal finance is personal. There's no right or wrong answer. It's just what you want out of life. And it's having that plan and kind of meeting that plan. But I would say, dream big dreams. Have kind of dreams that are going to have these goals that are going to push you to kind of drag you out of bed on a cold, February morning. That's going to inspire you to kind of get up and go, rather than just kind of a to-do list of a checklist. Have a kind of big goals that are going to inspire you to make things happen. So number 3 is have an emergency fund. So an emergency fund is essentially kind of a cash buffer to if things go wrong. So life, nothing always goes right in life. It always kind of bad stuff happens, and having enough of an emergency fund that's going to kind of make sure that you're going to cover you for unexpected things. So this is different for different people. Kind of the average or the kind of the number people talk about, kind of financial planners talk about, is having a 3 to 6 month worth of expenses, depending on your situation. But it depends on if you have a family, you might need a bigger expenses. If you've got a regular paycheck, maybe you need less of a kind of a savings emergency fund. But having £10,000 in the bank, just imagine that. Imagine 2 people. So one person with £10,000 in the bank, one person living paycheck to paycheck, kind of not sure if they can meet kind of their expenses coming up. They're going to have 2 different experiences, 2 different life experiences. One, the person with £10,000 is going to be probably pretty relaxed, pretty chilled, pretty life's good. If you don't have that kind of savings buffer, that's going to be stress, worry, that's going to be a big kind of big burden to carry. So have an emergency fund is really, really powerful. Make sure you have enough money to cover you. Make sure you pay off the kind of high interest debt before you kind of start investing in the stock market. So number 3 is have an emergency fund. Knowing how much is enough. So enough is, you're going to think, when you get to financial independence, you're going to have actually, how much do I need to have enough? We talk about this in other meetups. We've done this kind of working out how much your financial number is. I've got videos on YouTube, on my YouTube channel, Millennial Money Mindset, exactly how to calculate how much is enough, the mathematical, how much you need. And it's having that kind of the balance between the kind of the fulfillment and the consumption. So in that graph, you have that people live on a survival mode, then that kind of that comfort, then it's kind of having enough. And then if you kind of, the next step is maybe you kind of have the luxury, and then you kind of have that exuberance. So your fulfillment goes down the more consumption you have. So economists have talked about this, have kind of done lots of scientific research about that. And essentially, the more kind of money you have, it doesn't necessarily always make you happier, but it comes back to there's kind of a sweet spot of enough. And it's that getting that balance right. So how much is enough to live your dream life? If you live in a big house, you're going to pay, you're going to need to pay for it. So it's working out what's right for you. Essentially, as we said, Personal finances is personal. So number 4 is diversification. So the spoiler alert, the 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 image that I use in my book, Millennial Money Mindset, is splitting your money between land, so property, so the roof over your head. Property, you can now pay, you can buy property for £1. There's certain platforms you can go on and you can just pay for a pound for, a share of property. You can have like these real estate investment trusts, or it doesn't have to, even though it's crazy expensive if you live in London or in Oxford or any other kind of global city, there are ways to invest that's not going to be that's going to be accessible, that is going to be accessible for everyone. I'd say have money in the stock market. Stock market is one of the best ways to generate wealth over the long term. You're buying kind of the most productive and efficient companies. You can buy hundreds, if not thousands, of companies all around the world that's going to generate profits. If you go into a McDonald's, people are paying for a Big Mac. Part of that profit is going to go back into your pocket. If you see people using an iPhone and you owe Apple stock, part of that money is going to go back into your pocket. And make sure you have enough money in reserves. This is cash, bonds, have insurance. If you have this is going to give you a massive peace of mind. I'm not saying this is the most efficient or getting the best returns, but purely money mindset where you're not stressed and worried about money. Because all these markets move differently. So they have the stock market tends to crash at different times of the property market. If you've got money in reserves, if the stock market crashes, then you've got money to invest when the stock market is on at cheap prices. So this is going to be a real kind of for when I had this in my personal life, I didn't stress and worry about money anymore. This was kind of a big epiphany for me. I had property, I had money in the stock market, and I had enough kind of in reserves. That was a real kind of mindset shift for me. So people say the stock market goes down. Yes, it does go down. But if you look historically, so this graph goes back to 1789, and this is the Dow Jones average. So you can see all the kind of the ups and downs. You can see the kind of the 1930s crash. It does recover. You're investing in human innovation, human ingenuity. You're investing in human invention. So there's new products, new technology, always going to be invented. Humans have new problems to solve. So, and you're getting wealthy by you're investing in these problems that these companies that are solving these problems. So capitalism has provided good returns for the long term. So you can get wealthy on this. So, and I would say don't invest in one company, invest in funds or invest in trackers rather than invest in one company. You're reducing your risk by 60% by spreading your money in around hundreds, if not thousands of different companies. Spread your money. We talked about property. Yeah, have these dream houses here. Maybe these are kind of out of a lot of people's budgets. If you look at the kind of right move, how much they are, but have a dream. Where would you want to live? There are definitely strategies of buying property that is not going to be that expensive. I bought a property in Bristol because at the time that was much cheaper than where I lived in London. So I now own that property outright, and that money's coming into me every month. There are definitely strategies strategies that I go into with my clients on how to make money from property. And then keep money in reserve. So we covered quite a lot about kind of have money in keep money in cash in a bank. Make sure you don't keep all your money in cash. That's risky in itself, get eaten away by inflation. Don't keep your money in one bank. There's the FCA have it's basically if a bank goes bust, you're covered in the UK. It's something called the FSCS, which has covered you up to £85,000. So don't keep all your money in one company. You can put your money in bonds, you can have insurance, cryptocurrency, gold. So this is ways to spread your money around. So and then finally, step 5 is rebalance. So rebalance is probably the trickiest one to explain, but it's scientists have worked out that actually, if you rather than selling, you can actually set up. If you rebalance strategically every year, you're much likely to. There were studies that actually, rather than selling, you rebalance. So basically, you're selling. You're putting back into your asset allocation that was right for you. So you can rebalance your portfolio to keep it in line with your risk profile, rather than if you had money in Bitcoin, for instance, like probably 10 years ago, that went up massively. If you took out some of those profits, some of those winnings, tax efficiently, and bought other assets when that came down, you're basically reinvesting, and it's going to go. You're going to basically, it's going to be like a positive spiral. So making sure that risk profile is right for you. So risk versus reward. Make sure you're not going to be stressed out taking too much risk. Equally, you want to be taking enough risk that's going to generate enough profits to get you to that financial independence. So make sure every year, so you put a date in the calendar, check in with yourself, stick to a plan, make sure you're looking at your finances strategically every year, make sure you reduce risk, look at your fees, look at simple things like even look at how much are you paying for your heating, how much are you paying for your mobile phone bill, how much are you paying for your insurance. Just every year, make sure you're not overpaying. And this is going to be kind of long term, this is going to be really useful. And then you can automate this. You can actually automate your rebalance. You don't even need to do this. There are definitely platforms, investing platforms that help you do this automatically. So you don't even need to do this yourself. But yeah, it's definitely a good strategy to do it manually the first few times. So the best analogy I use to talk about rebalancing, it's like harvesting your farm. So think about when you're basically plucking that apple, you're basically eating the fruits of your labor. So this is what you're going to be doing when you're retiring. So retiring, so you basically got asset accumulation. Once you have enough assets, then you're going to be decumulating your assets. You're going to selling off these assets that are going to fund your retirement. You're going to fund your financial independence. And the aim is to have enough assets that are generating enough gains or enough dividends or enough income that's going to cover your expenses. So yeah, make sure that there's a rule called the 4% rule, which I talk about in I go with through my clients, and we talk through in other strategies, other videos and other meetups. And yeah, make sure you're guarding against risk, making sure your portfolio is resilient against tough times. Don't sell at the bottom of the market. When the markets crash, people get emotional. We get kind of the psychology of money. There's a lot of chemicals get released in the brain when there's market crashes, when there's fear, when there's it encourages to sell when we're not meant to sell. So that's the 5-step method. So own yourself first, dream big dreams, have an emergency fund, diversify, and then rebalance every year. And I go into much more detail in the book, Millennial Money Mindset. If you want the fruits, you need the roots. Make sure you pick that up. It's £15. The investment on that over a long term, if you take some of those key insights, it's got loads of insights, kind of, teach you how to invest. Yeah, it will pay dividends in the long term. So back to you. So I'll stop recording. And then we're going to talk about some action points and then any questions. Oh, sorry.
Well, regarding questions, for example, when we look at the current situation in the markets, for example, right now we see that, of course, gold is rising and interest rates have been reduced by Fed
Yeah,
last week, and we are pre-election in the US, and that like there is some kind of sense that like some kind of economic downturn is
yeah,
kind of expected, at least some kind of, I would say, um, some kind of correction in general.
yeah,
So, is it a proper strategy at this point to think about, like you said, like consistency beats complexity, and
yeah,
also like timing the market and stuff. So, would you advise
yeah.
at this point that we go towards, for example, waiting a bit till we see what's going to happen risk-wise on a wider level, or go towards, I would say, investing immediately and then, like going towards longer period of time in the market?
It's a really good question. So I would say there's two things. So understanding between investing and speculating. So what there's two different things. So I I would keep them two separate. So I'd have an investing account and a speculating account. If you want to time the market, if you want to play and um, actually, if you think there's going to be a crash coming up, you can time that. I've got a short position on at the moment because I think at the moment yeah, especially with the the Fed decision and the US elections, I think the market is quite jittery. So I've personally got a short position, which means you make money when the market is down, but I keep that separate to my investment account. So you can definitely, and I would say it's all about asset allocations. It comes back to the biggest. So my, so the biggest thing need to understand. So two biggest things. So money mindset and an asset allocation. So how you allocate those assets. So if you want to play, you want to time the market, keep them separate. So I wouldn't spend more than 4% of your overall net worth on speculating. And if you want, you could start doing some clever things. You could start, leveraging. If you're talking speculating, you could start doing things like, leveraging, having stop losses, and actually, taking a position. But I would keep that separate to your investing account. So investing is about owning. If you boil down to what actually is investing, so it's owning the means of production. So from an economics point of view, so if you ever studied economics, one of the first things they teach you is owning the means of production. So what does that mean? So that's property. You own land, you own factories, you own companies, you own own companies that are generating profit. So even in a downturn, people still need to eat food. People still need to heat their homes. People still need medicine. There's still going to be companies that are going to generate profits. So when looking at all the evidence, everything comes down to evidence. What is tried and tested? So yeah, tried and tested. Probability is better just to stick it long term. If you're investing, coming back to that graph, if you look at 1930s crash, there was a spike down. But if you're in it for the long term, you're thinking decades. You're not. If you're 30s, you're not going to take that money out. You're not going to take that fruit of your labor for another 10, 20 years. So by trying to time the market, you're going to be paying fees. You'll be paying this, call it the spread offer, bid offer spread, where you're buying the difference between the buy and the sell price. So ultimately, if you look at the probability that you're going to lose out more than you're going to win, if that makes sense. Does that answer your question?
It pretty much answers it. Yeah. And when we talk about the asset allocation as a concept, and
Yeah,
right now you're telling we should go towards diversification in general, investing in indexes or in funds that have diversified portfolios of investments. So depending on age and like on some kind of financial situation, what kind of, for example, approach should you tell to somebody in mid-30s thinking about, for example, the future, having, let's say, some, I would say, safety nets around himself, but still, like being in a tech which is at this point, like not the best place to be, but still a good place to be, let's say. So in general, when we talk about that, should I go towards, let's say, I don't know, like 30% bonds and then, like 20% ETFs and 50% like indexes that are widespread, or any kind of other asset allocation strategy?
So the best way I describe it. So next event on the 5th of November, we're going to be talking about this exactly what we're talking about. So we're going to this session was more mindset. So inner game. So you've got two. You've got inner game, which is like your goals, purpose, inner things, and then you've got your outer game, your asset allocation. The best way I describe it. So I use a football. This is a game I've created. So think of it like a football team. So depending on what you want out of life, you can have a defensive strategy or you can have a attacking strategy, and then you can have a build the portfolio around you. So what you talked about earlier, already got quite an aggressive strategy. You've got 5% startup. That's your striker. So you already got a striker in your team. So if that does well, you're going to be quids in. But that's the probability of that happening is less likely than if you just put money into an index tracker. So it's down to you really. So I guess as a money coach, I'm not regulated. I used to be a financial advisor. I used to be authorized and regulated by the financial authority to give you financial advice. As a money coach, I give you the tools to empower you to make your own decisions with money. So it really depends on how comfortable you are taking risks and how your other assets play out, and also how secure your job is as well. So you don't want to be tied up in lots of kind of startup capital if you need that money quickly. That startup capital, money tips is a startup, and it takes a long time to grow before you're going to be able to take dividends out of that. So it depends on your mindset, how stressed and worried you are with money as well. I mean, cash is king at the moment. I mean, I know inflation is eating away of it quite a lot, but if you've got a high paying job, and you can invest every month, then you're in a good position at the moment. In terms of prospects for 2025, the world's changed. I think AI is gonna have a big impact on jobs. I think a lot of people can maybe AI will take lots of lawyers who are high paying. Maybe there won't be as many demand for lawyers as there used to be. I don't know, just because of you can use AI. I don't know that. So that's just some of my thoughts. But yeah, I've got no crystal ball. I can't predict what I can't predict what's going to happen.
Okay, that's a pretty good answer. And when we, for example, talk about like some kind of strategy, when I look right now, I actually own 5% of like VC, small micro VC.
Yeah,
That can mean a lot, but that's maybe half, let's say roughly 2 to 3% of my net worth. Majority of my net worth is in my apartment on which I don't have loans. And I have a salary in a personal company. And companies, like I would say doing medium well. Now it's fine, but for example, in 2 months it can go bust. And I have small amount of interest in a bank, let's say on a yearly level for a couple of, I would say, grocery shopping tours, which is still fine.
yeah,
And I have 20 to 25% of money after paying taxes and after giving myself some kind of minimum pension contribution to actually invest. And apart from taxes and living expenses, I travel a lot. Business-wise, it's covered by the company, but usually I have 2 to 3 trips costing 1,000 to 2,000 pounds per year, which are, let's say, personal holidays or something like that, which I'm thinking about reducing. So, any kind of tips regarding that?
So you mentioned pensions. Pensions are really good tax efficient way to do it. It's really boring. As a financial advisor, that was one of my main strategies. But to get people excited about pensions was quite tricky. But if you look at the nuts and bolts, you look at how efficient they are, especially if you're a business owner, you can max that out. It's, is it 40, 50,000 pounds a year you have, you can you can put into a pension, which is and you get tax relief on that. That's really good strategy. Obviously, it's a long-term strategy. You can't take that pension out that money out of a pension until you're was 55 at the moment. I think it's 56. It'll be 57. Probably by the time that we retire, if not more, if the government change. So pension is really good. Use your ISA allowance. ISAs are really good. If you're a UK resident, that's a really good way to do it. I think it's hard to beat a global index tracker that just tracks the market of globally, where you're buying thousands of companies all around the world. And it depends on it depends on what you want as well. So, and how much time you have as well. So how much time you have to research and how much interest you have in it as well. So you could look at kind of your like, if you want to get really good at it, you could look at what are your specialists, what you're actually good at. So for me, an example of this, so I studied geography. I love kind of looking at places around the world. One of my strategies is buying growing countries. So the BRICS, Brazil, Russia, India, China, South Africa, having a global presence, looking at these kind of growth companies in kind of growing countries around the world. That's long term. I think China is going to be more of a bigger player than it is at the moment. It's growing hugely. So yeah, that might be a good strategy. But then getting your money out of China might be quite tricky. With this risk, with this reward comes high risk. Yeah, China could be quite if it makes the government makes a decision, that's it. You might not be able to get your money out.
What
These
about
things
Nigeria?
I mean, this is long. So, I mean, if you're talking, there's a really good book called by Ray Dalio. He talks about kind of empires. So what he talks about, British Empire was kind of big in, I don't know, whenever it was 1750s or whatever, during the Industrial Revolution. Then USA has been huge, big empire. He talks about kind of that empire moving over to China, and then potentially the next empire would be Africa. So Africa has got such vast resources, but I've got money in Africa. I've got a fund in Africa, thinking 20, 30 years. It's huge growth potential, and it's able to leapfrog technologies. What I mean by that is, so take the mobile phone, for instance. It didn't need the infrastructure to have landlines. So in the UK, we all had to have landlines. You phone a friend in the 90s. Pick up they didn't have to install that technology because they all use mobile phones. The same thing is going to happen with the internet. The problems that Nigeria had, corruption, payment, the internet and blockchain takes away a lot of those risks. Yes. Yeah. So I'm a big fan long term, 20, 30 years of Africa in general as a continent, and Nigeria. It's a hugely growing population, young population. So yeah, it has all the tick boxes, but yeah, you have to be patient. That's my opinion. This is just an opinion. I don't, lots of things could happen.
Well, and when we were talking about China, how much, I didn't even check, like how much like complexity there is, or like is it easy with the, let's say, platforms like interactive brokers or something like that? Is it complex to buy, like, I don't know,
Yeah, it's
shares
super
of
easy. Yeah, so to be honest,
Tencent,
you just buy a
Alibaba?
fund. You could just buy a China fund, Asia fund. You could probably put in a bit of, for a bit of diversity, South Korea, Samsung's a huge company, or, Vietnam's fast growing. These countries are, but yeah, high risk, high reward. These are higher risk compared to kind of, you know, arguably, Western Europe kind of stable countries, UK, maybe not so much, but yeah, France, Germany, even Australia, Switzerland, these are kind of stable countries. Whereas, yeah, not going to grow so much, but yeah, kind of developing countries. These are your strikers of the team. If you're thinking next week, next month, or in November, we're going to be talking about this much more. But yeah, so that's action point. So have an action point. So coming back, can you see the screen? I kind of lost a bit of yeah. So just think what tools you need. Books. I would encourage you to buy Football Formation Asset Allocation. Go on the website moneytips.org. There's books. I've got like 10 books. What if you're looking to trade? One book that's really good is what is it called? Reminiscence of a Stock Operator. If you're talking about trading, that's a really good book. That's this guy is it's it's a fiction book about by Edward Laferne about the richest man in the world. He basically during the 1930s crash, he basically shorted the market, and it's a very kind of interesting tale. But it teaches you how about speculating if you want to take more risks. That's a really good book that I sell, Reminiscence of a Stock Operator. But yeah, I'm mindful of time. Let's so money coaching. If you want money coaching, 498 pounds, or for 6 weeks, basically I give you support. We build your portfolio. That's £83 a week for. So we build your confidence, build a portfolio, get the asset allocation right. We look at different strategies like tax strategies. Look at your pension, look at your ISA, looking at your insurance. Yeah, looking even to build a business. You get loads of stuff. This is all this stuff. But yeah, or check out my website moneytips.org. So if you do buy Millennial Money Mindset, we plant a tree for each copy bought, and then 5 trees for every coaching program bought. But yeah, keep in touch. You sent me your email, so I'll send you the free Automate Your Finances for More Me Time. But are you on YouTube? Do you use podcasts? So subscribe to Millennial Money Mindset. Millennial, it's about 2 L's, 2 N's. I've got trying to build it up, so it takes ages to build the subscribe. So you can subscribe and watch, and I'm trying to build it up. There's loads of information on there. But any other questions?
No, regarding me.
But yeah, okay. But yes, join. How did you find this place? How did you find this? Was it on Meetup or?
Meetup.com, yeah.
So yeah, so sign up to the next session. We'll go into more detail about kind of asset allocation. It's going to be really super useful. So this has been more kind of your inner game, a bit more kind of fluffy, a bit more kind of focusing on your goals, etc. Whereas the next will be much more practical, kind of actually how to invest for the long term. And yeah, we can talk about kind of different strategies. If you want to play defensive, where you don't want to take more risks, or from the sound of it, you like to take a bit more risks, and we're going to look at different strategies. But for me, that's it. Please, please please tell a friend, and please, get Millennial Money Mindset. Go on my website, moneytips.org, and go to books and go to Millennial Money Mindset. That's the 3rd edition. There's it's available on audiobook as well. If you're like busy, please have it. You can listen as you drive or you get the bus, etc. Yeah, hopefully that was useful. But I'll stop sharing. But yeah, let me know if you've got any other questions. Send me your email address if you haven't already. Send me your email address, and I'll send you over um, the free the free training. Okay, take care. Thanks a lot.